all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the Long-Term Investor, proud member of the Retirement Podcast Network. In this episode, we're diving deep into the world of dividend investing with Taylor Schulte, who did a fantastic dividend investing series on another Retirement Podcast Network podcast called Stay Wealthy. Together, Taylor and I will debunk some common myths and provide you with a clear understanding of how dividends work. We'll also explore the pitfalls of focusing solely on dividend yield and discuss the importance of considering total return when building your portfolio. I think you'll really enjoy some of the analysis that we have based on the dividend-focused funds compared to the broader market, as well as just going through the tax implications of dividends versus stock buybacks and how to create a sustainable retirement income. So get ready for an informative, engaging discussion that I am sure will enhance your investment strategy. Now, let's get started. Taylor Schulte, welcome to the Long-Term Investor.
Peter Lazaroff, thank you for having me.
I appreciate you coming back on the show. You had such a good series on dividend investing. People can check that out at Stay Wealthy. We're both members of the Retirement Podcast Network. And I think that one of the topics that does come up a lot are these dividend investing misconceptions. I hope that we can dig through some of this, and I will obviously link in the show notes at thelongterminvestor.com all 4 episodes from your dividend investing series. But why don't we just start with the basics? What is a dividend? How does it work? What is the thing that you tell people right out the gate?
Yeah, I mean, what kind of sparked my interest in doing this series was seeing a lot more tweets and YouTube videos and articles touting dividend investing, that it's this really easy way to create income and it's a really easy way to make money in the markets. People go as far as saying that dividend investing can make you money while you sleep. And so you and I both know that that's not true, that there's a lot of misconceptions around dividends and dividend investing. And so I wanted to use this series to kind of clear up a lot of it and really help investors understand what dividends are. And so in short, I mean, dividends are not free money. Whatever you happen to read or stumble across on the internet, just remind yourself that dividends are not free money. A dividend is simply just a portion of a company's profits that they're sharing with shareholders. So a company that you invested in, they made some money, and in turn, they're deciding to give you, a shareholder of that company, a partial owner, some of that money that they made. So money is actually leaving the company's pockets. It's being removed from their balance sheet and it's handed over to you. And so the key thing here to pay attention to is that the company, when they pay a dividend, has less cash as a result after paying that dividend. So dividends are really just a way for companies to share some of their profits, some of their excess profits that they've deemed that they don't need to continue operating, to share some of that with their existing shareholders.
And companies, when they have profits, they have 3 choices. They can reinvest in the company, they can pay a dividend or return cash to shareholder. And the other way they return cash to shareholders are stock buybacks. But the reason that I mention that is when we go back and look at returns of any given index or any given company, you can break it into 3 components. It's changes in earnings, it's cash returned to shareholders, either via dividends or buybacks, and it's changes in valuation. I think sometimes when people are looking at the dividend, the tangible nature of it draws them to it. And so you'll find people who want to wait to sell a company until the dividend is paid or buy it before it's paid. But in fact, when a dividend is paid, the price of the company drops by that amount. Because as you just mentioned, now there's no more cash. Well, not no more cash. That cash is not on its balance sheet any longer. It's not some sort of cheat. It's not some sort of extra return, but it is an important piece of it.
Yeah, you do see a lot of that floating around the internet that like, hey, you can just jump in and buy this company right before they pay their dividend, right? Collect the dividend, collect that free money, and then sell the stock. And as you kind of alluded to, it doesn't really work like that. There's this thing called the ex-dividend date, which determines who's eligible to receive the dividend. So even if you buy the stock before the ex-dividend date and you are eligible to receive the dividend, the price of that stock is going to drop by the amount, or typically drop by the amount of the dividend on the day it's paid. So maybe it's worth sharing a simple example, and I shared this example in my series, but let's just say your favorite stock is trading at $50 per share. and this company declares a 50-cent dividend per share. In other words, for every share of the stock that you own before the X dividend date, the company is going to send you 50 cents. So Peter, if you own 100 shares of this company prior to the X dividend date, well, $50 as a dividend is headed your way. However, as you mentioned, on the day this dividend is paid, the share price of this stock is going to adjust accordingly. So in this example, the share price would adjust to $49.50. It's reduced by 50 cents, the amount of the dividend that's paid. So Peter, instead of you owning 100 shares at $50 per share, you'll now own 100 shares at $49.50. plus the 50 cents per share that you now have in cash. Now, as many listeners know, you can reinvest that 50 cents right back into your investment, and now your investment is unchanged. You have the same total value in your portfolio. But if you go and take that 50 cents, Peter, and go spend it, well, then your portfolio has less money as a result of this dividend. So there's no magic here. It's not free money. Even if you try to game the system and hurry up and buy the stock before the dividend, well, the share price is going to adjust anyways. So you're not really in a better place as a result of the dividend.
And I think what's confusing to people is when that stock price adjusts, there's more going on in the world than just the dividend paying out. There are people buying and selling. And so you won't necessarily see this in action when an individual company or a fund for that matter pays out the dividend. But that is what happens. And I think that's a big misconception in general. Perhaps we've already guided people to a bit more clarity where you don't need to buy or sell your individual stock or your fund ahead of or after the X dividend date. The other thing I think is we run into from time to time is people just getting so focused on the dividend yield when they're building a portfolio or choosing investments. You talk about in your series some better ways to think about portfolio construction. Do you mind going through that?
Yeah. And I think it's worth highlighting too that going back to this dividend reinvestment opportunity, when you get that dividend, you have the option to either spend it or reinvest it. If you just spend all the dividends that you receive, if that's your income source for retirement, well, over a long period of time, your portfolio is not going to keep up with the broad indexes. If you're just spending that cash flow, you're probably not going to be in the same place as if you were reinvesting it. So it's an important thing just to pay attention to when you have that option. Typically, the default is that your investment will automatically reinvest those dividends, but some people get in a habit of spending them, and just know that that's going to affect the long-term value of your portfolio. So just something to keep in mind there. But yeah, this is a common problem in investing. Investors getting too focused on the yield of an investment, the yield of a fund or the yield of a stock, and choosing to own that fund or that stock just because of the yield that it's paying. And so this can lead to a lot of problems. It can lead to a riskier portfolio, and it can lead to lower future expected returns. So instead of letting your needs and goals and risk target drive how you construct your portfolio, you're simply just allowing the yield of an investment to dictate the risk return profile of your portfolio. So it's really backwards. You have to keep in mind that the highest yielding dividend stocks, they have the highest yields for a reason. They typically have high yields because a lot of them are junky, overpriced companies, and they're issuing these high dividends to try and attract more investors. So if you buy a basket of high yielding stocks or a high yielding mutual fund or ETF, it's naturally going to include some of these junky, overpriced companies, and that's going to drag down the long-term returns of your portfolio. So in short, targeting yield and just buying something for the yield will likely, over a long period of time, increase the risk of your portfolio and reduce long-term returns. And I shared this quote from Meb Faber, which I think kind of just sums all this up before we talk about what's a better way to maybe go through the construction process. Meb Faber said that one of the basic tenets of investing is that if all else is equal, the less you pay for an investment, the better your future returns should be. And by that logic, the better the value at which we can purchase quality assets, the better position we should be for increased returns going forward. In other words, valuation matters. The price you pay for an asset has a significant influence on the return or lack thereof that you'll get. So we want to be careful about buying something for the yield because we might be buying things that are overpriced, right? Overvalued. And buying things at a low price is really important to long-term success. So stop there and see if you have any thoughts before we talk about, well, if we're not going to buy something for the yield, if we're not going to let yield influence our portfolio, then what's a better way to go about the portfolio process?
Well, I love what you shared there. And I assume that you're going to start talking about total return because ultimately, as an investor, I don't really care where the dollar comes from. And that's one of the things that happens for a lot of people with a stock or a fund, and they're used to getting a certain dividend, and they don't want to make a change to their portfolio because they spend the dividend, or they like the dividend, or that dividend is, in their mind, reliable. Whereas in reality, $1 of price gain is the same as $1 of income. Yes, it can be fleeting, but ultimately, the total return is what matters. And I think there's a whole generation of investors that didn't necessarily come up in a world where total return was emphasized. I mean, heck, even bond investors weren't thinking about total return until Bill Gross sort of turned the whole concept of bond trading on its head a couple decades ago.
Like you said, I mean, your returns are going to come from a couple different sources, from dividends, interest, and capital gains, capital appreciation. Like, I don't really care where it's coming from. I want to focus on what's the total return of my investment. That's great that a fund is yielding 9%, but if my total return is flat or negative after everything is factored in, like, what did that 9% yield really do for you? So yeah, we want to be careful about just looking at the yield. We want to look at the total return of your investment. And we can talk more about maybe total return versus yield and creating income in retirement and how that all plays together. But I do think it's important to maybe go back to the construction process. And if, again, we're not going to choose something for the yield, which, believe it or not, I think is just more common than most people think. I think people get really hyper-focused on what's the yield of my portfolio, what's the yield of that stock or the yield of that fund. Most people just get this backwards. I think that your needs and goals should drive how you invest your money. And so if we think about it in that way, that we should let our needs and goals drive how we build our portfolio, how much risk we should take, then from there we can say, okay, we know what my needs and goals are. I know what my risk target is. Here's a simple 3-step process that I put together for how somebody can go about building a portfolio that, by the way, it's going to pay dividends. Naturally, this portfolio will pay dividends, but the dividend yield did not influence how the portfolio was constructed. But of course, it's going to pay dividends because 75% of all US large cap companies pay a dividend. So if you have a properly built portfolio that's diversified, it's naturally going to pay some dividends. So to me, step one of this 3-step process is just determine what asset classes belong in your portfolio, and just keeping it simple through your research or through what your advisor recommends. You might determine, hey, I want exposure to US stocks, international stocks, and real estate. Just really, really simple example. But step one is what asset classes belong in my portfolio based on what my financial plan says and my needs and goals and risk target. Then step two is the quote from Meb Faber is, we want to make sure we're buying good asset classes or good companies at good prices. So now that we know what belongs in the portfolio, let's use our preferred valuation metric and let's determine what companies or segments inside of those broad asset classes have attractive valuations and higher future expected returns. So maybe you determine by using something like the Shiller PE ratio that small cap value stocks are undervalued and large cap growth stocks are overvalued. So as a result, you might not remove large cap growth from your portfolio entirely, but you might tilt the portfolio a little bit more towards those small cap value stocks and maybe a little less from those large cap growth stocks. So that's a decision that you can make. And then finally, once you've identified some of these undervalued asset classes that you want to maybe overweight, then it's time to identify and implement your portfolio. What holdings are you actually going to purchase? And to determine what investment solutions you might use. You might use individual stocks or mutual funds or ETFs or a combination of all three. But regardless, your goal here is to ensure that you're getting the desired exposure to the asset classes that belong in your portfolio at the lowest cost. That's our goal there. And again, since 3 out of every 4 large cap US companies pay a regular dividend, my portfolio here, this 3-step process, this portfolio will naturally pay some regular dividends, but the dividend yield was irrelevant to me during this whole construction process.
You know, it's one of the things that when people talk to me about not just stocks and funds, but options or hedged ETFs or overlays, again, the income, people get so obsessed with the income. And there's a lot of people pushing income-oriented strategies. You actually performed some analysis on dividend-paying strategies versus the overall market versus non-paying dividends. Can you share some of those findings?
Yeah. I mean, this goes back to focusing on the total return of something, that just because it has a high yield or a good yield doesn't necessarily mean that the total return of your investment, when all factors are considered, is going to be healthy. So yeah, I went back to January 1st of 1995. And by the way, we don't have a ton of history here because there's not a lot of dividend-focused funds that have been around for a long period of time. A lot of them have closed or merged. So there's not a lot of history here. So I went back to January 1st, 1995, where I found a total of 17 open-end dividend-focused funds that are still in existence today. So these 17 are all still in existence today. And of those 17 funds, 15 of them, or roughly 88% of them, underperformed the Vanguard S&P 500 fund through March 31st of this year. So from 1995 to March 31st of this year, almost 90% of them underperformed just the simple Vanguard S&P 500 fund. So again, sure, on paper, they had higher dividends, but the total return was much less than just the broad market. Now, listeners might be saying, well, sure, but like two of those funds did outperform. So why don't we just find those two and just own those two? But hopefully we're all in agreement that unless you have a perfectly working crystal ball, it would have been impossible to pick those two funds 30 years ago and held those for those 30 years. And those two funds out of the 17 would have outperformed. Like just getting that right would be really, really challenging. Also, I think it's worth noting that just so people don't think I'm picking on these like old school, high cost, actively managed funds that, of course, like these high fees drag down their returns. One of the funds measured out of these 17 was Vanguard's very own dividend growth fund. The ticker is VDIGX. That was one of the 17 funds measured that underperformed during this time. So even some of the lower cost dividend-focused funds have underperformed as well. It's not just these high-cost active funds. So yeah, over long periods of time, these dividend-focused funds, they typically underperform these broad markets for a handful of reasons, which I'm sure we'll get to. And I think what's maybe interesting, maybe not all that interesting, I don't know, but like 88% of these funds underperformed. That's pretty much in line with the underperformance of just all actively managed funds in the universe. Roughly 80 to 90% of actively managed funds underperform the passive broad-based indexes. So it's really not all that surprising that 88% of these, let's call them kind of actively managed dividend funds, underperformed. It's right in line with most other asset classes.
That's a great point. And also the fact that you found 17 funds doesn't really even acknowledge the fact that probably a lot of those funds failed or got merged into funds. It's something that people don't really realize, that thousands of funds come out every year and hundreds, if not thousands, are closed every year or merge into another one because they aren't performing as well. So you've already picked a sample that's benefiting from survivorship bias. And yet, to your point, it's still having the success rate that a traditional active manager would have. And I also think, kind of going back to something I said earlier about the three components of return, it's changes in earnings, cash return to shareholders, and changes in valuation. And that cash return to shareholders, perhaps dividend investing in the 30s, 40s, 50s, 60s, 70s mattered. But when the SEC made it possible to do stock buybacks in the 80s, that really changed the landscape of how corporate finance worked. And just to paint a picture for listeners on buybacks, I feel like, generally speaking, they get misunderstood, but companies are buying back their stock on the open market. So they might announce, Apple might say, we're going to buy back $4 billion of stock. The one thing that when you're a company, if you announce a dividend, cutting the dividend is a big no-no. But buying back stock is a more flexible way to return cash to shareholders because you don't really get penalized for the same way when you cut a dividend. You cut a dividend when you're in bad financial health. The market realizes that. The price often sells off. When they buy back stock, it's not like you have to buy back. They just go and buy it on the open market. I think you quoted a stat about something from like 1997 to present, like the growth of buybacks far exceeded what dividends were paid. And in general, when you have the choice of paying a dividend and reinvesting in the company or buying back your stock, or doing nothing, I guess you could just leave it there in cash, buying back your stock sometimes is the best investment that you can make for a company. What sort of things do you feel like we ought to cover on buybacks for people to understand within that context?
I think at the most basic level here, again, like companies make money. And when they have excess profits that they don't believe can be used to help fuel future growth for this company, they have some options available to them. And buying back stock is one of them. Issuing dividends is another. Again, these aren't like magical things that automatically just make them a great company. These are just choices that companies have to make. And if you're going to invest in a company like Apple, you want to trust that their leadership is going to make the right decisions with excess profits, either hold on to a bunch of cash or distribute some of it through dividends or do some buybacks. there's a lot of, not a lot, but more and more negative press around stock buybacks. I would just remind yourself that stock buybacks aren't necessarily good or bad. There's just a tool that the company has, an option that the company has to do something with some of that excess cash. I mean, we can get into the weeds all we want. If you want to go check out the episode that I did, I dig into some of the nerdy details there. But just in general, I don't know, companies have an option. And this is one of those options. It's not necessarily a bad thing or a good thing. It's just one thing that they could do with those excess profits.
Well, and again, for those of you listening, if you want to check out Taylor's episodes, go check out Stay Wealthy on your podcast app or visit thelongterminvestor.com, where I'll have links to all the shows from the dividend series that Taylor has put out there into the world. And we were talking about how the dividend-driven strategies tend to underperform, or at least historically have underperformed, the S&P 500 index. Some of this is because they're poorly constructed. Some of it is because the fees are higher. But as it's related to buybacks, taxes is another thing. So when you get a dividend, you have to pay the dividend tax rate on that. When there is a buyback, that capital appreciation that is theoretically happening, you aren't taxed on that. You have a little bit more control over your tax bill. Now, it's not perfect, but ultimately, you have to trust that the way that the company is managing themselves is ultimately going to be optimal. Not everybody can be Amazon, where they're just investing in new businesses and having them turn out. If you try to keep reinventing the wheel of your company, eventually you're just going to be wasting shareholder value. There was a long period of time where the pharmaceuticals, big dividend yield payers, were just acquiring and acquiring and acquiring. And now they're kind of gone in reverse the past decade, where they're spinning off units because they were destroying shareholder value just to acquire things and make earnings grow. It didn't really have enough consideration to the full picture. And so when we think about dividend investing and how our goals should really be aligning with the way that we're building the portfolio, I think there is a right way and wrong way to be doing this, don't you think?
Yeah, I do. And on that note about taxes, it's often forgotten about, especially when we're reading these articles or seeing these charts online. They don't typically factor in taxes to the analysis. And like you'd mentioned, every time you receive a dividend, well, you're also receiving a tax bill, assuming that this isn't a taxable brokerage account for, let's push to the side pre-tax accounts or Roth IRAs. But in your taxable brokerage accounts, when you receive a dividend, you're also receiving a tax bill. Even if you reinvest that dividend back into the fund or the company, you have a tax bill that year. And those taxes can be a drag on your portfolio. So this highlights the importance of, number one, just paying attention to the tax ramifications of your investments and ensuring that if you're going to have a taxable brokerage account, you might consider targeting maybe lower yielding investments in that account, something called asset location. We might put more tax efficient vehicles in that taxable brokerage account to help mitigate that tax bill. But there is research out there that says that depending on your tax bracket, the tax effect of dividends can reduce your annual returns by up to 1.5% per year. So this is a real threat to your long-term returns by not focusing on taxes. And if you're just buying the highest yielding stocks or highest yielding funds, talk about total return, those taxes can further drag down that total return as well.
100%. And I think there's also research out that just shows the difference between companies with high investment in the firm and low investment within the firm. And we kind of go back to what is the best use of cash. And you will see from time to time, people demand that cash is returned to shareholders via dividend or buybacks. Usually when you have an activist investor, they say, stop wasting money on these projects. But there is pretty good research in there that the high investment versus low investment, there are differences in return that you can see in the data in peer-reviewed research. And that's why it all comes back to developing not just your portfolio, but your financial plan using evidence, using facts, not feelings. Taylor, I know you've also done a lot of work talking about different withdrawal rate and income planning strategies. How does all of this fit into that within the world of dividend investing?
Yeah, I mean, creating retirement income is often a big challenge for people. They can DIY their investments, their financial plan while they're accumulating money. Pretty easy. I'm making money, I'm saving money. I'll buy some low-cost index funds. And all of a sudden, they amass a nice sizable nest egg of a few $1 million. And like, how do I turn this $2-3 million into a retirement income stream? And again, the popular method, or one that seems most attractive, is I'll just target the yield, right? I'll just go buy some stocks or some mutual funds that have a 3, 4, 5%, 6% yield, whatever yield I need. So that's certainly one way that you can go about creating income is target the yield and spend the yield or spend the income that the portfolio is spitting out. Now, we already talked about some of the issues with that you're letting the yield of an investment or the yield of a fund or a stock drive how much risk you're taking. It's not really factoring in your unique goals and risk capacity and risk tolerance. It's just like, well, some of those things might be riskier than you really should own. So that's one way. And by the way, I'll preface all this to say the best approach here is the one that you can stick with. So if you feel like dividend investing, you can understand it, it's the one that you can stick with the longest, it might be the best strategy for you. The worst thing you can do is try dividend investing one day and then go try some dynamic withdrawal strategy another day. And then I'm going to go buy an annuity and try that. If you start jumping around from strategy to strategy, it's a recipe for disaster. So it's worth putting some thought into this. And if it's the thing that you understand and the thing that you can stick with for a long period of time, even if it's not maybe the most optimal, it still might be the best solution for you. In my mind, you have two options. You can chase yield and you can let yield dictate how much income that you have and how much you can spend, or kind of going back to this total return approach. I'm going to put together the best portfolio, the portfolio that matches my retirement needs and goals, the amount of income that I need, the amount of risk that I need to take or want to take. And I'm going to let that drive how the portfolio is constructed. And I'm going to kind of create my own dividend by creating a withdrawal strategy, a systematic, repeatable withdrawal strategy. The number of different ways that you can do it. The one that we follow is often referred to as Guyton's guardrails. And these guardrails are in place to help us dictate how much money we can take out of the portfolio on a monthly or quarterly basis. So I'm withdrawing not just from the dividend yield, because again, my academically sound portfolio is going to naturally pay dividends. I'm just not really overly concerned. I don't let those influence the construction of it. But when I go to take my withdrawal, it's going to come from a mixture of the dividends and interest and also capital appreciation. And I'm going to sell from that total pie systematically every month or every quarter or every year to generate my retirement paycheck. So I want as much of my money working for me as possible, this total return concept. And then I'm going to determine what's a safe amount that I can withdraw on a, again, monthly, quarterly, annual basis, whatever is right for you. How much can I safely withdraw from that total portfolio and not just focus on the yield? I'm going to focus on the total return of it. So this essentially helps you mitigate the amount of risk that you're taking. Again, if we're focusing on yield only, we might go through periods. Right now is an interesting time because you can get 5% risk-free on your money. But what happens when interest rates go down and risk-free rates are down to 2% or 3%, and now you need a higher yield in order to sustain your income? You might be forced to start to take more risk than you're comfortable with in order to get the yield that you need. So chasing that yield is going to lead to potentially higher risk in the future. Focusing on this total return concept and pairing it with a withdrawal strategy that makes sense for you, I think, is a better long-term approach to creating income in retirement.
I'm with you, Taylor. And a lot of times when I feel like people are wrestling with ideas that don't necessarily fit their worldview or seem confusing and counterintuitive, I always like to go back to the whole first principle of why we're investing in the first place, which I believe is just to grow your wealth at a rate greater than inflation without taking undue risk. And when you are overly focused on any one factor, it's not that that's the risk part itself, but it does lead you to things that you aren't necessarily systematically rewarded for, whether it's your portfolio or I was meeting with a client yesterday. They had invested in a condo because they wanted the income. Again, the income drove the decision. It's very tangible. And it was fine that they did it. We told them it would be a hassle, that they'd barely break even. And they didn't really want to admit that they went ahead and did it. And we didn't mind, but they're like, yep, you were right. The income is there, but we're not actually making any money when you look at the time, when you look at what you have to put into it, with the frustration. Obviously, that is very different than buying an ETF with a yield, an individual company with a yield, but it's just one piece. And I love the way that you always outline the withdrawal plan and the thought that goes into that, because I think if you had a client who never got to actually see where their returns came from, and all they did was look at the income you were generating, it would probably feel great. I know when we look at performance reports with clients, it's so transparent and there's all these line items, and some clients get really excited and fixated on the income line. And then the investment gain is much bigger, by the way. Compliance is listening. I mean that, like, if you give it a long enough time, the market growth is going to be much bigger than the income. And yet it's the income they're all excited about. And I would think you should be just as excited about the investment gains. And yet I think it's just that tangible nature of income we're trained to go for.
Sometimes when we talk about stocks and yields and dividends, I think people get a little, I don't know, their eyes start to glaze over a little bit and they start to get a little bit lost. For some reason, real estate seems to register a little bit more. You mentioned the condo thing. My dad owned a condo here in downtown San Diego, and he constantly talked about how great the rental income was on this condo, that he gets X% of dollars each month from this condo. He owned this condo for 10 years and rented it out. At the end of 10 years, the price appreciation was completely flat. 10 years, a big chunk of money in this condo did nothing for 10 years. So sure, he clipped some income every month from this property, factor in expenses, property taxes, and no appreciation whatsoever. This was not a great investment. So when you think about dividend investing and thinking about the yield or the income, as you mentioned, Peter, remind yourself, like, what if you bought a rental property and it paid nice income, but that rental property, that the price of it was flat or maybe even going down? Do you want a rental property that's flat or going down, even if it pays a little bit of income? Probably not. So sometimes when you just like relate this back to real estate, for some reason, it seems to register a little bit more. I also want to make a comment too. You mentioned goals and letting goals kind of drive this. I think this is another important thing to take into consideration. We're talking a lot about income today, but a lot of people, their goal is not necessarily to maximize the income of their portfolio. It might be, hey, I want to leave a sizable tax-free bucket of money for my kids to inherit. Well, if that's your goal or one of your goals, dividend investing probably doesn't match up very well with that goal. Do you want to buy high-yielding stocks and funds if you want to leave this nice sizable bucket to your kids 30 years from now? Probably not. And so thinking about what your goals are, and there's probably multiple goals, and those individual goals that you have should match up with those investments. So if we just get stuck focusing on income and yield, your portfolio may not be matched up with those goals.
And I think that's where feelings come into play. I think of the clients who don't want to do something with their dividend stock or fund because they like the dividend. You can like it, but how does that align or not align or misalign with your goals? So important. You have to kind of take a step back every once in a while, especially for investing enthusiasts like the two of us, like our viewers and our listeners. People get stuck in the weeds on this stuff. I think you've made a lot of things clear throughout the series that you did. Absolutely fantastic. Again, I'll be linking to it in the show notes at thelongterminvestor.com. Even though people can find you there, why don't you tell everybody watching and listening where else they can find you?
Yeah, I think youstaywealthy.com is the best place. You'll find information about me, about the podcast, about my firm. You'll be able to go and listen to past episodes. We've got some great articles on there as well. So yeah, Peter, I really appreciate you having me on the show. It's always fun to join you here and nerd out on some investing.
Absolutely. We'll be sure to do it again soon. Thanks so much, Taylor.
Thanks, Peter.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.